Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table. Welcome to Money on Tap. This is your personal finance headquarters, and we're glad you're joining us here today. My name's Seth Krussman, and joined here once again by Dan Mickelin and Ben Brayshaw. How you guys doing today?
I'm doing great, Seth. I'm doing real well.
Feeling really good here, too.
And you can reach us at 855-226-8551 or info@yourmoneyontap.com. And as you get to some part in this journey with us today, and you're like, hey, that's a really good point because Ben said something, right? That's what happens. And Dan and I all look astounded at each other like, holy cow, that was for the first time on air. We just witnessed that with Ben Brayshaw. And you'll get a chance to go ahead and give us a call and check in with us and ask more questions down the road. We're going to be talking about it's not timing, the market. It's time in the market that counts. Market timing is one of those things that if you've ever been around the market or invested in the market, it's a way that people have tried to capitalize on the market going up and sidestep the market going down, which makes sense, right? It's buy low, sell high, and then keep the profits. The truth or the data may be telling a different story there for us, and that's part of what we're going to be discussing today. I can't wait to get into it with you guys.
Yeah, the thing is, I just had a call with a client the other day. He said, listen, let's just get out when the timing's right. I'm like, I want to make sure we just don't lose any. People say that stuff because it's just a fear-based response, and that's normal. Well, if I just knew, or this, that, and the other thing. And I think, like the concept that, and I hate the crassness of the term, but, pigs get slaughtered. It's you want to take gains. You want to be used to buying and selling and enjoying a profit, okay? Because you're never going to sell at the high and you're never going to buy at the low. We don't create highs and lows. Big trading organizations create highs and lows. Hedge funds create highs and lows. Highs and lows are created by massive trading all at once, and it just goes up, 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 and then it locks, and then it pulls back because the buying has slowed down or the selling has slowed down in a huge crash. People get scared and everyone's selling all at once and there's very few buyers, and it keeps pushing the price lower and lower and lower until it becomes attractive to someone else to buy. We're only participants in the market. And until you recognize that you're a participant, I think then you realize, there is no market timing. There's just buying something that you believe is a good investment at the price you buy it, and you sell it when you think you've made a decent profit and what you intended to get out of the investment to begin with.
Yeah, people get way too emotional about it, and it's hard to call it too emotional when you're dealing with people's life savings or retirement plans. It's money; it is emotional, but when you're doing it on your own and you let that emotion seep into your strategy, what invariably happens is, as the market recedes and you're watching your values drop, you hit a certain point where you can take no more and you sell. And then as the market begins to recover, you really miss that sweet spot every time. And what ends up happening is you sell at the low, you miss the recovery, and you just underperform your expectations and you don't meet your goals.
Half the time you sell and you take a profit, you're going to see the price at your profit level. If you've made money, you usually see it drop down below again. You see stocks move around. Well, there's always going to be that stock that maybe doesn't do that, but buying and selling is not necessarily a bad thing sometimes. And you can really amplify your dollars just by realizing, hey, I sold, it took a profit. Hey, we had a pullback. Maybe it didn't have a great quarter, but you still believe in the company. And you're like, hey, they're going to rebound. What does that look like? Selling creates opportunity to buy a new buy, Yeah,
a lot of the commentators we watch and, we follow these guys on TV like everybody else, a couple of the sage, little bits of wisdom that I've heard along the way is, never be mad about taking a profit. If you made money, it was a good experience. Don't worry about that little couple extra points that you might not have captured. If it was a profitable exchange for you, then it's a good thing. And, look for those opportunities to buy the dip. I mean, very simple understanding, simple things that anybody can follow. If you believe in an investment, you believe in a stock, you've seen it peel back a little bit, just take those couple of points. Take it.
And how many people have we see get too emotionally attached to a stock?
Oh, yeah.
Oh, goodness gracious. Oh, this is going to be the winner. This is going to be the winner. And it's really the loser, and it keeps going down, right? And then people get so attached to it, they never sell even when it is a winner. And maybe they've got an okay winner, but they've never diversified. I have clients who have inherited stock from their parents, and they're huge assets, and they don't want to sell them because they're emotionally tied to the fact that it was their parent stock, or it's the last memory they have. Their dad told them never to sell it. I have one client said, my dad told me never to sell a stock. And be like, then it went down. It went down one day, and they're like, oh man, I should have sold it, huh? I go, you're the one who told me you're never supposed to sell it. So those things are real. And I think without a financial planner, you're just paralyzed in the trade. And that's really what the problem is having the ability for someone to look at it with an unbiased approach and say, there's nothing wrong with holding a little bit of stock if it's a solid company. But the amount of the asset you have in one single holding is financially dangerous. And people don't see it that way until the danger actually happens.
So is that not seeing the forest through the trees? Is that what that whole expression means?
Well, it's the forest through the weeds, probably, because you got your head so far down you can't see anything. But yes.
Well, folks, we have hardly made it out of first 10 minutes here today, and I'm already head over heels here. Folks, this is going to be a lot of fun for us. So you can tell we're already excited to jump into the topic. So before we get too far down the road, or the forest through the trees or weeds, whichever that is, it's time for Money in the News.
So the first article that we popped up here today comes from CNBC, and it was written by Jessica Dickler, and it's talking about something that kind of catches the attention and you can have a little bit of fun with. It's Britney Spears, everybody. I mean, it's hard to take that serious right off the bat, but
let's get some wisdom, Dan.
And this isn't really about the conservatorship or any of that other stuff, and it's got nothing to do with Vegas, but the reality is, the latest news, the latest twist and turn here is that she's about to get remarried. And the article has to do with the fact that she's going to enter into a prenup in this marriage. And, I feel like that probably makes a lot of sense with some of the track record and decision-making going on there. And what I was surprised to see is that her net worth is still at $50 million, which is incredible. Good for her.
Her dad didn't spend it all?
Or steal it all, whichever one, I guess, whichever way you fall on that particular topic. But, it brought me back and reading through that and thinking about one of our shows lately about millennials. And there's a couple of trends in that generation. And I think, we hear about it often in planning. It's that particular generation married later in life. So very often they're bringing things into a marriage that, in prior generations would have been a marital asset, So these people own homes, they've started businesses, they have things that they achieved kind of individually when they were on their own in the world. And as they enter into marriage, there's got to be a real consideration around, is a prenup appropriate even if you're not worth $50 million?
Well, I think there's a lot behind that, because I think what I found interesting about this article was that it wasn't just about how much you have. It was about how much you don't have. Like, people don't want to enter into a marriage with somebody who's carrying, $250,000 of college debt.
Very true.
I thought that was really an interesting point. I honestly don't know. I mean, I could have clients with prenups out there. I just can't think of one. Or they haven't disclosed that factor, but
we got to put that on the list of documents to bring in when you're sitting down with us, right?
Exactly. So, but I think it was an interesting point, because we are a world of debt, right? I mean, people have house debt. They have, hey, listen, I own this house, right? Let's say you bought a house today. Real estate's at all-time high, right? You buy this house, you accept on, let's say you buy a $500,000 house, you got a $400,000 mortgage, and you get married, you don't have a prenup. 5 years later, things don't work out. Real estate market's crashed. The property's worth $300,000. You just inherited a whole heck of a lot of half a debt. And it might not be something you thought you were marrying into an asset, but you might be marrying into a debt. So I think that was really probably the most poignant item to me that jumped out of kind of the unobvious conversation pieces around prenups, and something that, I mean, I'm not a proponent of prenups. I mean, I just think that you go into it. But this one attorney then brought up the point that so many people argue about money, and we work with a number of, Christian, family, marriage organizations, and we help support them, and we help people with advice. And financial matters are top 1 and 2 issues in a marriage. And actually, we chatted about having them on the podcast at one point, getting them on the radio. But I think, if it's a top 1 or 2 item, and I know all of our listeners are probably saying, yeah, my wife and I argue about money, or hey, my husband spends too much, or any number of those things, and he goes off and does whatever, and I gotta figure it out. I mean, or she's spending money on clothes at TJ Maxx every day, or what, those we have those conversations in our lives, and yet, if you had a prenup and you separated your finances, it eliminates that argument, which was an interesting point by that one attorney in here, which was Penelope Hefner. She's a family law attorney out of Sodoma Law Union in Monroe, North Carolina. Not something I had thought about mitigating that issue, but a different perspective for sure.
And even just having the conversation around whether it is or isn't appropriate in your given relationship might uncover some of these unknowns about, well, what are the true state of the finances? What are you bringing to the table from both sides of the ledger, asset and debt?
Yeah.
Which otherwise, might just kind of skip past that until it's almost too late.
Well, I was pretty sure when I got married, my wife and I both had nothing. But in today's world, with people getting married at 30, 35, everyone's got a little bit of financial history already. The one history we had was nothing.
Well, how many of us would say that there's value in premarital counseling? And I've said probably one of the best premarital counseling things that anybody could go do is buy some kind of a significant piece at IKEA and sit down and put that thing together, and then go meet with your counselor and see what you think. But, for what it's worth, one of these prenups can run $1,200 to $10,000, and just the amount of arguments that could be bypassed or out, just get that stuff out in front of you, whether or not you decide to have a prenup. Just the conversation of what would a prenup look like, and sitting down with your marriage counselor. There's tremendous value in having conversations, honest conversations about finance before you decide to tie that knot, folks, because money changes people, is the truth. It does. And it's an interesting relationship when people start talking money. What happens in that conversation?
So does IKEA furniture. I would have to second that one. My son Collins hears the word IKEA, I think he gets PTSD.
I'd rather just learn Swedish than try and put another one of those together.
Learn Swedish.
All right, Stephanie Simcoe. It's simple. Stephanie Simcoe from Yahoo Money says, here's how Social Security's looming shortfall could affect your retirement plans. We did report on this recently, the shortfall of Social Security looking like it's, maybe a couple of years sooner than it was, and, not really knowing maybe what's happened with our, with the asset level that we have to be able to bank on that Social Security and all the debt that we're running up right now. But the reserves basically expected to run out in 2033, 1 year earlier than previously estimated. Okay. So, if you're planning for that Social Security to run out, that's one way of planning. And then you're, subtracting a year off of the Social Security timeline, or you're just of the camp that you're like, yeah, that's not even possible. We're never going to see a day in this country where that planning has to come to fruition. Either way, it is an interesting conversation to have, and one that needs to be brought to the table.
Yeah, some of the interesting factors in the article was, we all know what year it is. We can all look at a calendar, but what this is saying is that if you're in your 50s now, expect to see some kind of a shortfall. And whether it can be addressed politically or not is the wild card you mentioned there, Seth. But, what the article also hits home is the way politics works today and what people campaign around. They make the point it's not a 2022 issue, so we're unlikely to hear about it or to have it be addressed anytime soon. So by the time it is a here and now present issue, it may be too late for the government to do really anything to restore the benefits to the level that previous generations got to enjoy. And so it's a real concern. And for us as planners, it's something that we can't set aside and wait for politics to solve. We need to begin to address it now.
That's a great point. And I think that's one of the things that's really a naive perspective on a lot of planning that's out there is that, hey, Social Security is something you're going to count on. I had a meeting today with a client, and just walking into retirement, we've prepped the entire time. We knew exactly what buttons we were going to push, moving right into that. And our conversation was, Social Security is irrelevant here. We're done. Great. It's free money for you for now. And that was a conversation we had 12 years ago, was making sure she could feel retired and safe and feel like her income was going to be provided for in a way that she wouldn't worry about. That's not going to be everyone's situation, because a lot of people, I know people who just live off their Social Security. They have no expenses. They paid everything off. They live super frugally. It's not that they couldn't create more income. It's not that they don't have enough money to, bring in kind of an average income above Social Security, but they don't need it. And so we have a problem in this country, and more than one, let's be honest about that, right?
Starting the list.
But I'm still focusing on Social Security right now, not Afghanistan. Okay. But, these are the things that we don't have solutions for. But what we do know is that people are still paying into the Social Security system, but we have 80 million Americans, more than twice as what's already retired, going to retire in the next 20 years, demanding money from that Social Security system, and less people paying into it every day. There's just not enough money, and they've been telling us for years they're going to run out in 2000. It used to be 2034. Now it's 2033. What are they going to do at that point? Tough decisions have to be made across the board. I remember CNBC, this one gentleman was arguing with Elizabeth Warren. He's like,
I knew she was going to come up sooner or later.
Every show.
Yeah. My least favorite person in Washington, or second for least favorite person. I'm not going to tell you who the first one is. So, but the thing is that he was saying, why am I collecting Social Security? I make way too much money. I don't care and don't need it. There are people out there that think that way, but then there's people out there that do need it. So that's socialistic. I get that. But we have a broken system. It's called Social Security, hence it's a social system. But we need to figure this out, and we need somebody to go in there and dig it out. And it's going to end up in chaos. The other piece of this is that if you think this is bad, it's the pension system that's horrible. And if you haven't listened to our pension show, you should go back and listen to that, because that system's not only broken, but no one's paying into it anymore either, really. And Social Security people are paying into it, and it's crashing and burning.
And just to quantify what that drop-off may look like, they take an average Social Security earner who brings in $1,500 a month or $18,500 a year off of the Social Security program. They would be looking at a $90,000 deficit over a 20-year retirement. And that's a big gap to cover.
Well,
that's real.
Yeah, and people who have pension buyout offers, those are things you really need to seriously sit down with somebody that knows what they're talking about, because, we have done on our show people who are collecting over $3,000 in their pension in retirement with the 2014 Obama Pension Reform Act, Multi-Employer Pension Reform Act. Their pensions were cut down, I think, $1,700 or $1,800, right, Seth? When we did that show, it was a hurtful, massive cut. And what do you do?
It was shameful. It was what was happening to people that were, fully retired and not capable of returning to the workforce, and their income being cut, in over half. And it wasn't like a sizable, significant income by any measure. And, how do you tell them? Sorry.
Yeah. And that one guy in that article, and I don't quote me on this, but he had I don't know if he had a special needs child at home or whatever it was. He had to sell his house and redo his entire financial situation. Now, he was probably the worst scenario, but to naively be collecting your pension and think that's just going to be the way it is forever, I'm sorry, I just don't think that's going to be the case.
Well, if this wasn't a happy enough conversation for you to start our show off with, it's even better here, because next up, from CNN Business, Chris Isidore reports to us here that car prices.
It's CNN, Seth. We don't really need to know how accurate this is.
Well, as you can tell, I'm starting to read the fine print before I start saying anything.
No, this is actually a great article. Dan brought this article to us, and but the thing is this is crazy. This Hurricane Ida has really hit us hard. I mean, we already have a car crisis in this country. You can't buy a used car or a new car. I mean, you go to car lots and they're spacing them out 15 feet apart to make it look like they got this big inventory. I mean, I talked to one of my friends who's a manager over at a car dealership, and he said, we sell hundreds and hundreds a month. We don't even have as many cars on our lot as we sold last month. That's crazy.
That's incredible shortfall. I mean, you read about specifically pickup trucks, but people are making money on cars for the first time in history, within a couple of years of buying them. I mean, it's really insane.
I know. It is really, really not. So I guess
Steinberg's Honda dealer, one of these Honda dealers in the area, said they lost 85% of the cars in this storm. And the losses are tremendous, but on top of the shortages because of the supply chain issues that they've had, it's just like a double whammy.
I know one of the major manufacturers just shut down production because they can't come up with the chips, right? So we have all these other pandemic and weather-related factors, playing into this marketplace. But the bottom line is, if you're in the market for a used car, expect to pay more, and good luck finding one. Yeah.
Forget about face masks, you guys. Start making chips.
Yeah.
Whoever's out there in manufacturing. I'm sure you can retrofit your face mask company to NPP. What is it? The protective.
Well, I think the crazy number here for me that I read into this thing. So Hurricane Harvey, if you guys remember that back in 2017, which hit Houston, create a ton of destruction. I mean, across the board. But that storm only destroyed between about 250,000 cars. Superstorm Sandy destroyed 200,000 cars. Okay? Ida, 500,000. That's more than both of those two storms together.
Yeah.
So I think here we have a car shortage, a chip shortage, and then boom, we just knocked out 500,000 cars in the country don't exist. And all those people, they need replacement vehicles. Those weren't second and third cars. Those are primary drivers, right? Mm-hmm. So
that's it. Only about 78% of them were insured too. So for people who owned cars there outright that were no longer insuring them, they're going to be looking for bus tickets. I mean, they're literally going to have no means to either find or, potentially buy a car, depending upon the marketplace and the inventory where they are.
And it's a good thing that we've got a show that we just really get excited about when we start talking about, timing the market and who's the cleverest of the clever out there. We're going to get down to some of the nuts and bolts. There's going to be some great takeaways here for you. We're talking about not just timing the market, but it's timing the market. You're listening to Money on Tap, and you can reach us at 855-226-8551 or info@yourmoneyontap.com. Don't go anywhere. We'll be right back. Folks, it is so much fun for us to bring you Money on Tap. My name's Seth Krussman, and I am one of the hosts here at Money on Tap. I'm also a financial planner. That's what we do. That's what Ben and I do. And the fun part is we get to have this radio show. We talk about important things that we think you need to listen to and be aware of to help raise the bar as far as your financial literacy. It's a big part of what we're trying to do here. The other thing that we're doing here as well, as financial planners, we are welcoming you to come and call us and to join us at Brayshaw Financial Group.
Experience what complete wealth management looks like. Let's take a look at all sides of the issue, get a three-dimensional perspective, and put a plan around your next step. It's so critical. And so many people just leave this part out and then they find out later, oh, if I only would have known. Hey, don't let that be your story. Give us a call at 855-226-8551 or info@yourmoneyontap.com. If you have $250,000 of investable assets today, our plan is free to you. We think it's important for you to know the facts and have a playbook so you can have a successful retirement. Give us a call at 855-226-8551. Thanks for listening.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap, and you can reach us at 855-226-8551 or info@yourmoneyontap.com. First and foremost, the topic today is we're not talking about market timing. We're talking about time in the market. Matter of fact, we are talking about market timing and tactical or active management in portfolios. What does that all mean? Well, it looks like this. There's some ways to engage the market. Okay, and maybe you've heard some of these sayings. It's buy low, sell high. Okay, so that's activity, right? You're actually taking action when you buy, and you're taking action when you sell. The goal is to have some profit there. Continue to take those profits and reinvest those, and then you start to have this compounding effect of your money. It's going in, it's working for you. And then comes this idea that's passive investing, and maybe you've heard of an index fund. Well, did you know you cannot actually buy the index, but what you can buy is you can buy different securities that mirror or act like or very similarly to some of these indexes like Russell 1000, S&P 500, the S&P 400. All of these are different indexes that are comprised different ways. The Dow is the oldest, longest storied index of the Dow 30. And, so you can buy these different investment vehicles that kind of mirror those. Typically, the idea with that is that you just buy it and you ride it out. I mean, it goes up, you go up, it goes down, you go down. But a tactical or an active strategy will say, hey, we're going to go ahead and take advantage of the market and try to buy this at this point and ride it up. And if I so choose to take profits, as Ben was talking about earlier, that means we're going to sell and we're going to move that money out of that strategy. We'll do that. Or you might just have this idea that, when the market turns around and starts to go down, well, we're going to completely sell out of some of this strategy or this fund or whatever money we have in the market and set that money aside and wait for a period until the market tells us that it's a good time to get back in. And that is predominantly what we come across in the idea of investing, as far as that tactical get out of the market money move, right? And we're going to talk a little bit about this, and we're going to talk about you and the investment strategies you're using right now, and probably some things that you might want to consider because, as in anything, diversification plays a role. And protecting you and this retirement plan that you have, there's some different tools out there that should be considerations, right?
Seth, you bring up a lot of stuff there. It's a lot of conversation.
And done.
Yeah, seriously, that's like the concept of people are always like, what kind of investing do you guys do? I have people approach me all the time like, hey, I have a question for you. I mean, I can't tell you how many times I've gone out to dinner with somebody and, invariably I get that question. We're all that person. I mean, people fire away questions at me all the time. Heck, we were just in a meeting. People were firing away questions at me. It was pretty funny. Our background is pretty vast in our industry. I mean, we have a pretty good, if we don't know the answer, we know enough, to understand what the concern is. I think that's really the biggest question, right? What is the concern? And what kind of investing do we do? So a lot of people, they just go in and they invest and they're at, it's no big deal. You're at Schwab or Ameritrade or any number of the, the big boys, and you kind of buy that investment and they put you in the 5 top choices and you just let it ride, and you really don't know, should I sell it? Should I buy it? It seems like it's doing good. And then we meet the guy who's trading a couple stocks and they're making a little bit of money. But we don't do that. We do something different. And I think when it comes to really managing money, Dan talked about it earlier, taking profits, don't ever be sad about taking a profit, and don't ever feel like you have to own something forever. And passive investing is just buying something and holding it forever. That's just like you're marrying that investment. And a lot of people do that with the S&P 500 or the NASDAQ, that tech world, the Russell. They'll pick their index and they'll just stick with it. And there's some value to that, right? I mean, there's traditionally a sincere value. Otherwise, passive investing wouldn't be the would be something that no one would do. Active investing is actually trading, actually moving in and out of the market. But I'll tell you that I believe both work. And you'll see this on CNBC. You'll see, hey, active investing is working right now. It's the best performer. And then 6 months later, hey, passive investing is the number one way to invest. And everyone is kind of doing that. And when you go to Fidelity or you go to Vanguard or whatever, they offer both. They always offer both. They promote low fees, and then next thing you know, they have someone calling you saying, "Hey, we can trade this for you regularly, and we'll charge you XYZ fee, which is really high." So they offer both, and everyone does. I think the thing is that the idea about market timing is that everyone doesn't want to lose money, and there's all this history that I think we should go through and discuss, like, what does it mean to move in and out of the market, and what am I giving up potentially by doing that? So we've looked at a lot of articles. We've got a lot of data here. For people who are numbers people, you're going to love this. For people who hate numbers, you might run away from it. But we're going to sum this up, and I think this will be great for everyone. But the S&P's annual return, between January 2nd of 1990 to December 30th of this last year, 2020. The average return, that includes all the best days, all the worst days, stick it in the market, don't worry about it, don't move it. You're looking at 8.44%. Now, this is an article that we have in Proactive Advisor magazine. Now, they acknowledge that if you missed 10 days, of the market, and it happened to be you missed the best 10 days, that 8.44% would drop to a little less than 5.5%. Not too terribly bad. Like, hey, if you got out of the market, you were fearful, and then the market rose 10 of those days, hey, you missed out on 3%. If you missed the worst 10 days, your 8.44% average return jumps to 11.26. Now, this here, I think, is the most remarkable item, which Dan actually pointed out to me, which I would have got there eventually, Dan. So some credit to you there. But if you missed the top 10 and you missed the bottom 10, so you weren't in it for the worst 10 and you missed the best 10 days, your 8.44% return would go up to 8.5%.
Yeah, and that's the notion of timing the market, right? Are you going to be wise enough and just have that crystal ball in front of you to perfectly miss the 10 worst days and to be in for the 10 best days, which is the notion of timing, right? You're going to miss the worst of it, capture the best of it. And what this proves in that duration is that the best thing to do was don't worry about it, just stay in. And the numbers prove true over a couple different intervals, right? So they took the example including the 10 best and worst days, the 20 best and worst days, the 30 and 40 best and worst days. And in the end, the average return that you would have captured if you had gone through all those experiences was still right about where the S&P returned over that period of time if you just left well enough alone. And the thing about the timing notion is that often the best and worst days happen very close to each other. And they give us an example here of March of 2020, which was an extremely volatile time, right? So if you looked at just that month, and if you were trying to time this, God help you, because it would have been virtually impossible. But on March 9th of 2020, the market was down 7%. On the 12th, it was down 9% again. On the 13th, however, was up 9%. The 14th, up 9%. The 16th, down 12%. The 17th, up 5%. The 20th, down 4%. And the 26th, up 5%. And those were all the most dramatic days of the year, all wrapped into 1 month.
Right. And I think the point there that I think is most profound to me as I was looking through that is that the 16th, so March 16th, the market was down 12%. The next day it was up 5%. And a few days later it was up again. So like if all of a sudden the market goes down 12% and you're like, oh, darn it, I got to get out of the market, you're going to miss the next 2 days that are all the recovery pieces to that.
Yeah.
And that's really the loss, because you're either in or you're out. And there's a lot of conversation about that. We're going to talk a little bit about what we do. We're going to talk a little bit about how we do our timing of the market, because we do believe there's times to be out of the market. Because if you're in the market all the time, then you take on vulnerabilities and risks that maybe you don't want to have. And so we do have some mechanisms that we use. But as we kind of go through these numbers, I think it's really interesting that at the end of the day, I use that 10-day moving, the 10-day best and worst, right? We talked through all of that. But if you look at the 20 best and worst, the 30 best and worst, the 40 best and worst days, right? You never make over 9%. You never go over 9%. So if you just stayed in the market, 8.44% every day, good, bad, and ugly, never looked at it, okay? You're talking 30-year history, 8.44%, 8.5%. But you never do worse than that in any of the scenarios of being in and out of all of them. But the most you get to is 8.94 with a whole lot of work. That's the thing I think people need to understand, right? The very best thing you could do is be out of the market for the 40 best days and the 40 worst days. And the best you could actually accomplish by doing that is 8.94%. So for a 0.5% gain average, that's a whole heck of a lot of fear, work, and effort to make sure you hit all of those 40. You're creating statistics and odds that are impossible.
I think one of the things that's important to, we're talking about a lot of numbers here. We're going to take a break in just a minute here as well, and then come back with some more. But one of the things I just wanted to highlight is if you're listening to what Ben and Dan have been talking about and saying, oh my gosh, where is this information? Just give us a call at 855-226-8551, or you can reach out at info@yourmoneyontap.com. And we're more than happy to, get you the information and spend time with you talking about the strategies that we're invested in, and what are we doing in this activity in the market, in and out of the market, and how and why we feel that this is a part of our investment strategies. It's not the end all be all, but it's a significant part of what we're talking about here. The how and why that works. We're going to come back in just a minute. You're listening to Money on Tap. We're talking about timing the market, or is it time in the market? Reach us at 855-226-8551 or info@yourmoneyontap.com. We'll be right back.
If you're listening today and your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
Now back to Money on Tap with Ben and Seth.
Welcome back. You are listening to Money on Tap. Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. You know, we've got so much information in this show that we're trying to get to. I have forgotten to just first of all, thank you for spending the time with us here today. We appreciate you. You could be doing a million different things, but you're here, you're with us. And we just want to let you know we recognize the value there, and we're grateful. If you're listening on the radio and we're flying through some stuff here and you want to go back and have another listen to the show, you can find us on podcasts at any one of the podcast venues out there. Just download the app on your smartphone, search for Money on Tap, and away you go. We've got over 180 shows in the backlog there for you to search from. And one of those shows, actually Ben mentioned, had to do with pensions and the struggle around pensions. And that is such a huge story for so many people that are engaged in retirement or looking to be in retirement. And it's one that I just want to highlight again, because it is truly an imperative piece for people to understand when talking about consistent income or the expectation around guaranteed income or consistent income for their retirement, because maybe it's not going to work out that Social Security is the end all be all there. There's other ways to create your own pensions. And it's a whole other show. Actually, we've got several shows back there that we talk about it, but just one of the highlight reels to bring forward. We right now are talking about investing in the market, okay, or timing the investment in the market, or is it time in the market that counts? And believe it or not, it's here at Money on Tap, where we talk about three-dimensional investing, right? We're not going to leave any of this off the table. We're going to get into some scenarios right now, and I can't wait to see how this might work out in different people's planning and timing. And also we're going to bring some stuff back next week that's going to tell you more about our strategies, how we operate in taking a look at the market and understanding when an opportunity is to exit the market, or when we feel strongly that this is when we want to be in the market. And that's going to be a lot of fun for us next week too.
So yeah, talking about timing the market, I think it's important to note that, really being in does behoove you. And a simple stat, looking back over the last 5 years of the market, is that there are, in fact, more up days than down, right? So taking that time range into account, there was 569 down days compared to 689 up days. So 54%, almost 55% of the time, the market is in fact up.
Yeah, I think a lot of people realize that, they become unable to make the decisions. And we use the word paralyzed for more selling, but I think just having direction is half the problem, right? So everybody almost looks for, whether they're opening up a 401k, for someone to say, hey, listen, how should I invest these dollars? We have people come in here, a guy the other day, we've done a whole financial plan for him. We've set up everything for him on his old funds, his new funds, and then he's got a 401k. We reallocated that. We changed the distribution, the contribution pieces for him from a traditional 401k side over to the Roth side. And there's a lot of involvement in really planning for retirement, and the sooner you do it, the better off you're going to be. But the timing piece of this, comes into play, that if you don't have the capacity, meaning you don't have the knowledge, the know-how, the ability, the understanding, and just the time to evaluate the market, don't do market timing. It's not your place. It's not your business. It's going to hurt you. You're going to be hurt. You're going to lose out, because at the end of the day, you're most likely going to sell in an emotional event. Stock market drops, like we talked about in the March 16th. Stock market drops 12%, you're out, boom, market goes up 5%. You just lost a whole lot of money. That's a 17% round trip loss. So those types of things, people say, oh, I just missed the 5% gain. It's like, no, you missed 17% because you couldn't participate in the recovery. So if you don't have that background, buyer beware, don't do it, don't try.
And you got to appreciate how hard it is to recover too. Once you exit the market, just plain simple numbers, if you experience a 50% loss, people think, well, I'll make my 50% back, but the fact of the matter is, you need to make 100% just to get back to where you were.
Yeah, I know. That's unfortunately the reality there, and I think, the idea that Warren Buffett says 90% of stocks, 10% bonds, S&P 500, simple bond fund, let it ride. I mean, I can't say that I would necessarily agree with that, but I wouldn't disagree if you're completely unable to get help. It's like, I'm not giving a recommendation, but I understand his point. It's like, hey, the market's up, yet that 8.44% we talked about earlier, that's the statistical history for the last 30 years since December of 2020. Hey, he's saying your odds are in your favor to just go this way, because anything else you do will probably only hurt you. That's really what he's saying, is anything you're trying to do on your own, you're probably going to cause a catastrophe. And for the person who's investing their own money at home, and the wife or the spouse is watching them do this, that's a lot of stress. That's a lot of anxiety. If you're the person listening, knowing, and it probably is, the person who's managing at home is probably the person listening, trying to figure out, what can I do? How am I going to do this? That's a whole lot of stress. That's a burden to bear. I mean, I can tell you the families we've talked to where the husband lost 30, 40, 50, 60%, 70%, 80% of the funds in 2008. They lost almost everything. And they literally crying in my office, I don't know what to do. Everything we've worked for is gone. I've seen these people come through the door trying to figure it out themselves. Way too much burden for you to bear. And you have one chance to do it right, one chance to be successful. Don't put all that on your own shoulders. That I think is foolish when you're kind of approaching that third base and you're coming around to home plate. So is that something? I think right now, let's talk a little bit about, and I'm going to turn this over to Dan. Let's talk a little bit about 5 people that we have an article on. It's kind of interesting. And it's this is from Schwab, right?
That's right. Yep.
Yeah, this is from Schwab. And because I think it's 5 people that you may be one of.
So it's 5 different styles or ways to invest that the article touches on here. And, I think we'll dive into it deeper again next time as well. But, it really hits home about this notion of, is it even possible to time the market, and what effect would that have? So the examples they have is everybody's getting $2,000 to invest at the first market day of the year, right? Yeah. And so what do they do with that? And they come up with some pretty interesting names here. So Peter Perfect takes his $2,000 and he invests it, buys in at the exact low point every single time, and sells at the exact high point.
Guy's a champ.
Every single time.
He's a champ.
He's got the crystal ball. If he's available, he's the advisor you want.
Get him on the show.
Yes.
Peter,
we could all use Peter Perfect. We could all use a little of that. Ashley Action, she's a little bit different, right? So she took their $2,000 and she bought in on the first day of the market every year. She just immediately went right to market.
January 1st.
January 1st, she's in. Matthew Monthly, he did something that we talk about often here, which is dollar cost averaging, right? So what he did is he took his $2,000 and he divided it by 12, and he bought in on the first day of each month. So he understood he wasn't even looking for highs and lows. He just said, I'm not going to be able to figure that out. Let me just have another disciplined approach, and let me just buy in on a dollar costing average basis, which again, first day of the month.
So he didn't think January 1st was the best day to invest. He wasn't sure.
He didn't know, is that the high day, is that the low day? I don't know. I'll just do something consistent, right?
Yeah.
So he bought in on the first of the month each and every month. Rosie Rotten, other end of the spectrum here, right? So
Rosie Rotten.
her and Peter Perfect, and we're looking at different research here for sure. But she bought in at the high point each and every time, sold at the low point. Did it absolutely the opposite way you want to do. And then Larry Linger, he did nothing at all. He just took his money, stuck it into, he bought treasuries or kept it at the bank. But either way, he was not even attempting to time the market. The whole risk of the situation, which just was not for him. And then what they do is we took a look at, how these people fared over time. And of course, very interesting findings here. But of course, Peter Perfect nailed it, right? So he had by far and away the best returns, off of his investments over time. using the statistics we have here, he netted $151,391 in his portfolio. So a pretty good take.
Nice work, Peter.
Did it absolutely perfect, as the name
Well
would
done.
suggest. But what's interesting here is that the next two invest immediately, right? So again, buying in the first of the month or the first day of the year,
yeah.
right? Just dump
One
it right
time.
in, let it go, full investment, the full 2,000. She ended up with 135,471, whereas the dollar cost averaging, right? So he just took the opportunity to buy the first of the month, even investments over the course of the year without even trying to time it, ended up at 134,856.
I mean, those two numbers are less than 0.5%, I think, between each other.
So
or
those
right
two
around there.
strategies performed eerily similar. I mean, almost right on the nose.
That's scary, actually.
So a very interesting finding there. And then the other interesting finding is, even Rosie Rotten, who got it absolutely backwards at every possible opportunity, she ended up with 121,171, which wasn't too far off, but significantly
She's only
outperformed.
She's actually only 10% lower than the dollar cost averaging, and the dollar cost averaging is only 10% high. I mean, the perfect timing was 10% higher than those. So, I mean, ballpark. So you're looking at 151, 135, and 121. I mean, that's
all within range, and they all really outdid Larry Linger here. He ended up with 44,000.
right.
So bottom line here is a couple things shine through here. No matter what you do, you're better off in the market, first off, right? And
Even if you're choosing the worst possible
even
timing
if
to
you're
get in.
the worst investor in history, you do better than leaving your money at the bank.
Yeah.
Right?
Yeah.
Bottom line.
Sorry, we have no Larrys around here. So, well, I think I think the thing is I really do subscribe to the dollar cost averaging. I think this, to me, it's ironic that invest immediately on the first day of January every year happen to beat it by, but we're talking about like 0.5% over the entire course of the time. It wasn't 0.5% a year, and we're talking about a few $100 difference in final returns. I would much rather take the dollar cost averaging because I don't know exactly on the timing of this, but I bet you could run this illustration over various times in which you receive them. Because a lot of people do.
Right. If you start on January versus starting on,
February
March or what? Yeah. Be an interesting. That would be an interesting comparison, wouldn't it? If what if you just rolled it back another month or another month from that? Which sequence worked out better?
I think I would wager with the two of you guys that dollar cost averaging the majority of the time starting at different months would win.
Oh, I'm in on that. I'm going to go ahead and take you up on that. You let me know how the results comes back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com.
And I think what I want to say is as we bring into another show, there's a lot of information around market timing and what that looks like and how you can maybe subscribe to that method of investing and be an active investor. We're going to talk about that more in our next show. We're going to talk about moving averages. We're going to talk about exit strategies. We're going to talk about, what we do here, some of the things we subscribe to and how we look at that. You can't do what we do. I get that. I mean, we do things specifically inside our own intrinsic management that, we're not going to let out to the entire public, but there's things that you can look at. There's things that you can figure out yourself if you really need to do that. But I would say caution is the number one thing here because you should not be an active investor without some financial professional behind the helm. And so we'll talk a little bit about that for people who are interested and dig through this because market timing can either be a success or the largest failure you have.
That's great. Yeah. If you were to take a look at a chart of like the S&P 500 over the last 30 years, which we were using as the gauge, who wouldn't say, yeah, I want that. I'd love to buy that, right? But I think one of the things people do not understand, and we're talking about risk and how people invest and why people don't get those returns, is because we, generally speaking, live within about that 6-month window. And if you were to take a look at any 6-month window of take your pick along that chart, you know what? More than likely, there's going to be a period in there where you're going to be like, no way, I would never take that. And that's why people have this tendency to even get out of the market. Folks, you're listening to Money on Tap. And I think so far we're saying, it's time in the market, right? Have a strategy, stay invested. Cannot wait to jump back into this with you in more detail next week.
You've been listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. You can also find us at Facebook. We're at /3D Investing. We're also on Twitter at BFG_LLC. And as always, you can also find us at yourmoneyontap.com.
Make it a great week. We'll see you real soon.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.
Well, bye.